And now, in order to understand fractional reserve banking, let's begin with a fictitious economy with no banking systems where transactions are settled through cash or credit. Now, cash trading happens when payments in our fictitious economy is settled through cash, and credit trading happens when transactions are settled through the exchange of goods. Lots of issues with these two methods of trading, such as bad credit, theft, incentive problems, and liquidity problems. As the number of traders in our fictitious economy get larger and larger, it becomes increasingly difficult to manage cash or credit. As large payments become an issue, theft, counterfeiting, and other issues become a problem in our economy. Financial service providers are presented with an opportunity to manage cash and charge fees. Now, thus the warehouse bank is born in our fictitious economy. In exchange for service fees, these warehouse banks manage money, keep them secure, they accept cash deposits, they safeguard the money, they allow cash withdrawals, they authenticate money, and most important of all, they allow the transfer to portions of the deposits, of the cash deposits, rather than transferring the cash itself. So a transfer to the title of the deposit is facilitated rather than transferring cash itself. There's no need for transferring physical cash, and therefore the concept of checks is born in our fictitious economy. Now, when other financial wizards see the profitability in this warehousing banking system, the fictitious economy is suddenly spawning with new banks. From a monopolistic banking scenario, the economy now has multiple banks, with each bank issuing their own checks. A new problem, however, arises. Now let's give some names to these entities to avoid confusion. So let's assume that Yuri from Metrocity, our fictitious economy, needs to pay Sean a certain amount of money. In the monopolistic scenario, this was easy, as the check would have been written by the same bank at which the check would be presented. However, with multiple banks in our economy, let's assume that Yuri's bank is in Metrobank and Sean's bank is in Megabank. If Yuri writes a check to Sean, so if Yuri writes Sean a check from Metrobank for an amount of $1,000, Sean would have an issue to encash it in his bank in Megabank. Sean could go to Metrobank, encash the check, carry the cash to Megabank, and deposit the amount. Now this becomes very inconvenient for the payee. A new facility such as a clearinghouse is now required in the economy. Now, just a brief history of the clearinghouse. In London, to make matters convenient for customers, banks began to send walking clerks to other banks to collect payments on behalf of their customers. So you had hundreds of clerks walking all over London with hordes of cash, making the business very risky. The clerks, however, devised a smart way to reduce the number of walks. They all met in a coffee shop, exchanged checks with one another, and settled the net balances only. By 1770, banks established an official meeting place for clearing checks. By 1850, banks in England were settling deposits at the Bank of England rather than settling in cash. Now, this is an important point to note. In our fictitious economy, banks settle their deposits with a central bank rather than with cash. This means that there is now no exchange of cash and only changes in the balances of banks with the central bank. So the first clearing bank established in New York was in 1854. Now, returning to Metrocity, our fictitious economy, the banking system now advanced to a state where checks were settled in the net amounts in clearinghouses. So at the end of the day, if Metrobank owed Megabank 3 million in checks and Megabank owed Metrobank 4 million in checks, the net settlement for Megabank to pay Metrobank was $1 million. Now Megabank could defer this payment for the next day settlement or pay in cash. The risk for Metrobank is that Megabank could go bankrupt, thereby causing a loss to Metrobank, plus the physical movement of cash is also risky. So the government of Metrocity therefore decides to open up Central Bank. Central Bank now keeps a running balance of all the bank's deposits. So all Central Bank would need to do is adjust the balance of Metrobank with a $1 million credit and Megabank with a $1 million debit. So banks need to deposit some cash with central banks in Metrocity as reserves, and Central Bank therefore determines the reserves banks need to maintain. So we see that the payment system in Metrocity has evolved to exchanging ownership of deposits rather than cash. Now some financial wizards in Metrocity notice that the deposits in bank vaults are barely touched and the cost of payments has greatly reduced. So another interesting idea is born, and we will see how that new idea affects the money supply in the economy next.